Hello, my name is Elaine Garrido, and I'm a Senior Benefits Analyst with the UC San Diego Human Resources Department Benefits Unit. This presentation is the first of 3 seminars geared toward retirement readiness. I'll be facilitating this session, which we call Retirement 101. Here's our agenda for today. We'll talk about what UCRP is, the benefits of the plan, the UC Raise portal, take a look at a retirement estimate, offer you some thinking points, and provide guidance for your next steps on your journey. So we'll start with, what is UCRP? Well, first off, it stands for the University of California Retirement Plan. It is a primary retirement benefit for eligible employees, and it's a defined benefit plan. This means that the benefit you receive from the plan is based on a calculation, which we'll discuss later. On the right-hand side, we have some data about the UCRP membership as of July 1st, 2020. You can see here that the total active members through UC is 134,953, with more than half of them already vested in the plan. Here's a list of the benefits under the plan. First and foremost, there's a guaranteed lifetime monthly income. A lump sum cash out option is available to the 1976, Modified 2013, and safety tiers. The plan provides a disability income for employees in coordination with the voluntary long-term disability benefit. There's a death benefit paid to the beneficiaries in the amount of $7,500. A little known fact is that this benefit does not require you to be vested or retired. You just have to be a member. Income continuance is paid through survivors and/or contingent annuitants. We'll talk more about that in the next slide. There's a cost of living adjustment, or COLA, for retirees that is paid on July 1st for those who have been retired for a full fiscal year. The COLA is derived from the CPI for the Los Angeles and San Francisco metropolitan areas. If you have any sick hours at the time of separation, it will convert to service credit if you retire within 120 days from your separation. A rule of thumb for that conversion is that every 2,000 hours equals 1 year of service credit. When you do your retirement estimate, it'll tell you what that conversion is, so no need to worry about the math right now. A really popular feature of the plan is the retiree health insurance. It's important to know that this is not a vested benefit under the plan. That means it can change in the future, but right now it is being offered. Now we'll talk about the income continuance I just mentioned. Let's first take a look at the left side of the screen, Survivor. This only applies to the 1976, Modified 2013, and safety tiers. 25% of the basic retirement income is paid to the survivor when the retiree passes away. There's an order of the survivorship. The plan recognizes a spouse or domestic partner as the first survivor. If there is none at the time of the retiree's death, it will fall to the retiree's children if there are any children under age 18 or 22, a full-time student, or a disabled child at any age. And next in line would be a dependent parent. On the right side of the screen is labeled contingent annuitant. This can be anyone. It doesn't have any specific guidelines or title other than it needs to be one person, so not a trust or company. It provides income to a person after the retiree's death. It does reduce the member's retirement income, which we'll see when we look at some examples. And that reduction is going to depend on the age of the contingent annuitant as well as the payment option selected. So how does the plan figure out how much to pay out? Well, as I mentioned earlier, that amount is based on a calculation. Here are the 3 factors: service credit, age factor, and HAPC, which stands for highest average plan compensation. Service credit is earned proportional to your work effort. And that means if you work 50% time in a month, you only get 50% credit for that month. You don't earn any service credit if you're on an unpaid leave of absence or work in an ineligible position like temporary employment, postdoc, or house staff. Your age at retirement is another factor. It takes into account the year and month of your age, so you can see a chart on page 8 of the Retirement Handbook if you're interested in seeing what that number is. The HAPC is the average of your highest consecutive 36-month salary. The calculation you see here can be found on page 7 of the handbook. Service credit multiplied by your age factor gives you that benefit percentage. Taking that benefit percentage and multiplying it by the HAPC gives you the basic retirement income. There is some fine print on this slide that says 1976 members coordinated with Social Security have the HAPC reduction of $133 to account for UC's contribution to Social Security. Again, when you create an estimate, you'll be able to see the amounts. You don't have to worry about doing any kind of manual calculation. UC-RAISE is the platform used for the retirement data. It stands for University of California Retirement at Your Service. I strongly urge you to register for the site if you haven't already done that. When you first log in, you'll have to go through a series of security questions. You'll be able to bypass this in the future by selecting the Remember This Computer option if you're using your own personal device. The site will allow you to view your retirement information, create estimates, send secure messages directly to the UC Retirement Administration Service Center, or RASC, upload documentation during the retirement process, and check your retirement application status. Here's a look at the main menu. Membership details will tell you your membership type or tier. Not everyone knows what tier they're in or are surprised to hear that they are multi-tier, which means that they are members of more than one tier. This happens if you work at UC, leave for a period, and then come back and are placed in a different tier. You'll also be able to see what your UCRP accumulation is, or your UCRP pre-tax plus the 6% interest growth. Service credit will also be listed. This is the Retirement Estimates tool. It's what you'll use to create estimates for yourself. I recommend trying different dates. You know, a popular question we get in our office is, how much of a dollar difference will it be for me if I retire this year versus next year? Using this tool is a great way to figure that out. You can also try different contingent annuitants. Remember when I said that the amount depends on the age of the contingent annuitant? You'll see what I mean if you do one estimate using a contingent annuitant of your same age and then another one with a contingent annuitant who's about, 20 years younger. There's no limit to the number of estimates you can create and no commitment for actual retirement, so just use the tool and have fun with it. The last module here is beneficiary designations. Please click on this and review your beneficiaries. It's not just for the UCRP. It will actually list all of the plans you have an enrollment for, like basic life, supplemental life, and accidental death and dismemberment. Updated regularly, especially if you have a life event like gaining a new family member or losing a family member. More often than not, when I meet with the faculty or staff, they tell me that they didn't realize their former spouse was still listed or that they never added their youngest child. Remember, the importance of this is that UC knows who to pay benefits to in the event of your death. Now let's take a look at an example of a retirement estimate. When you create an estimate, you'll see something like this, and it can look intimidating at first glance, so we'll piece it out and talk about each offering separately. In this example, Christine is our retiree, Mark is her spouse, and she has also listed Mark as the contingent annuitant as well. We'll cover the basic retirement income first. This is the most that you can receive from the plan because there is no reduction in your amount. If Christine selects this payment, she'll receive $1,331.14 each month in retirement. In the event of her death, Mark will receive $332.79 each month until his death. $332.79 is 25% of Christine's basic retirement income. Payment options A through D have amounts listed in the contingent annuitant column. Payment option A allows for full continuance to the contingent annuitant. We can see here that Christine will receive $1,269.10, so it has been reduced. In the event of her death, Mark will receive the amounts listed for both the survivor and the contingent annuitant, and that's because he was selected as both. Now, when we add these two amounts together that Mark receives, we find that it is equal to what Christine had been receiving. And this is what is meant by full continuance. It's a popular option for households that want to maintain a steady income flow. For example, if you have a mortgage payment that relies on this income, it makes sense that you would still want to have this money available for that payment even after your death so that it wouldn't burden your family. Payment option B has a smaller reduction on Christine's amount per month, but a bigger reduction on Mark's amount. This offers 2/3 continuance to the contingent annuitant. Did you notice that the survivor's amount doesn't change? It will always be 25% of the basic retirement income, and it never reduces the retiree's amount. Payment option C shows us again a smaller reduction for Christine, larger reduction for Mark. This is 1/2 continuance to the contingent annuitant. Payment option D is not available to everyone. This is only for members who have an eligible survivor and if the contingent annuitant is the same person. In this option, you'll see that Christine's amount is much closer to the basic retirement income. There is no survivor amount, but the contingent annuitant amount is almost twice as much as the survivor amounts that we saw in the other options. Some individuals may see a Social Security offset in their retirement estimates. This doesn't apply to everyone. If you do see it, just know that it's a temporary supplement to restore the HAPC reduction that occurred during the calculation. It actually doesn't have anything to do with your Social Security benefits. This additional amount will stop once you reach age 65. The lump sum cash out option is available to the 1976 and modified 2013 tier members. If you would rather have one lump sum payment instead of a monthly benefit, you can select this option. You'll need to think about how you want to receive it. You can have UC write a check out to you after they withhold 20% for federal taxes and 2% for state taxes. Or you can do a rollover into another retirement plan like the 403B, and that way you don't have to worry about taxes until you're ready to take a distribution from that account. Just remember, taking the lump sum option means that you are forfeiting all the pension benefits. Your sick hours will not convert into service credit. Your survivor does not receive any benefits. Your beneficiaries do not get the death benefit, and you will not have the retiree health option. The capital accumulation payment, or CAP, was created for some members who were eligible at that time. There are currently 2 CAP accounts. CAP 1 was issued 1992 to 1994, with the UC contribution earning 8.5% interest each month. CAP 2 was issued 2002 and 2003, and the UC contributions for that earned 7.5% each month. If you have one or both of these accounts, you'll need to make a decision when you file for retirement. Just like the lump sum option, you can either have it paid to you with taxes taken out or roll over to another account and defer your taxes until the time you take a distribution from that account. We went through a lot of information, but I want to provide you with some things to think about. Your biggest question is probably, when do you want to retire? That's a personal decision and has so many factors that are important. Don't forget to run an estimate so you can see what different one date means for you versus another date. When you create those estimates, just know that a separation date refers to the last day that you're an employee, and the retirement date is the first day that you're a retiree, so these dates will never be the same. Once you have an estimate, look at your options. What makes the most sense to you? A monthly payment or a lump sum cash out? Talk to your family members, other UC retirees who have had to make these decisions, and definitely talk to a financial advisor. This session was an overview of the benefits under the plan. There are other resources out there just waiting for you. Attend a webinar or watch a video on UCNet. You can search for these by typing "When You're Ready to Retire" in the search field. Preparing for Retirement is a 1-hour presentation given by RASC that goes more in depth with UCRP. The UC retirement process talks about each step of the retirement process. While this is going to be self-service through UC Raise, just remember that your senior benefits analyst is here to help you through the process, explain what the documents mean, and answer your questions. I know I mentioned it many times before, but don't forget to create that estimate for yourself. It's the best way to help plan for your future. You should also attend the next session we're offering, Retirement Process, where we'll provide more explanation about the various documents that you'll be completing. I want to thank you all for attending today. I hope this presentation provided you with useful information and guidance. UC is an amazing place to work at, but the best of all the benefits we offer is the UCRP. I wish you well on your retirement journey. If you have any questions, please send them to benefits@ucsd.edu. Have a great day.